Now, back to this session, this very highly interactive session, the hottest topics and latest intel in SMSF. Now, presenter will explore two key measures affecting the SMSF sector. The better targeted super concessions, which is introducing an additional 15% tax on the earnings for members above $3 million, and the amendments of NALI rules for self-managed super funds relating to general expenses from the 1st of July 23. Let's hear about Aaron Dunn, our presenter. He's very well known in the SMSF sector and is seen as a trusted source for professionals to learn more about SMSFs and the direction of the sector. Aaron's insight into both technical and practice-based issues within SMSF sees him regularly sought after to participate as a key stakeholder across regulatory and policy issues. As an SMSF specialist and CPA with more than 20 years' experience, Aaron is the CEO and co-founder of Smartest SMSF, a specialist business that provides technology-based document and education solutions to simplify the complexities of SMSFs to accountants and financial advisors. He is a lover of sport and Essendon fan and athletics. Aaron was previously a nationally ranked high jumper, having set a best jump of 2.14 metres. Wow. Welcome, Aaron, to the stage. Thanks.
Thank you. I can't jump up onto the stage anymore either, so my back doesn't really permit it. So you're all here because you enjoy SMSF, you love the technical elements of SMSF, and today we are really going to dive into the technical elements of what is two key topics that are shaping the SMSF sector at the moment. And many of you are coming from the minister's session, and I kind of did stick my head in. I'm like, just let's not make sure he throws something else out to sort of influence the way in which this session might work. Ultimately, we're not, but we are actually right in the middle of discussion, negotiation, and even me needing to actually update slides as we went along with this presentation. So as was explained in the introduction, we are going to be focusing on two key areas today, and we did deliberately break this down to allow you to ask me some questions about the current drafting or the exposure draft of our what is now known as Division 296. And then we will move into the other element of this, which is around the general expenditure rules of non-arm's length income. How many people have their own self-managed fund in this room? Large number of hands. These rules may actually have a direct impact on what you're doing inside your fund right now. So we will go through and explore those and what that may mean for you in terms of the services that you might be providing to your fund and understanding which hat you might be wearing to be doing those services. So let's get stuck into this first element. So we now have a name, most importantly, when it comes to these better targeted superannuation concessions. So Division 296 in the Income Tax Assessment Act is where we are now going to land in respect to the way in which these rules will apply. And as I said, we have an exposure draft that currently exists, and we've only had a 2-week consultation to actually try and work through these issues. So in theory, this current government has really put the cue in the rack in respect to where they want to sit in terms of where this legislation is heading. Okay? The rules or the way in which this was originally proposed hasn't significantly changed through consultation and then in the exposure draft as well. The sense that we have is that, in reality, when we're seeing new legislation being introduced, 2 weeks of consultation, if we think about the level of consultation that's happened from QAR and so forth, is really insufficient to allow us to pull these things apart. And naturally, what happens is once you start to see more detail, you do start to find some of these issues, and I'll present some of those to you today. The primary concerns, however, still do remain. And they are the way in which the calculation works, because it includes unrealised capital gains. So we are using as a function of this calculation an individual's total superannuation balance. And the other thing is that we have a flat rate that applies as a threshold at $3 million. So where are we right now? we are at the point where, as an industry, we're no longer really having discussions with the government of the day, but rather, yes, there's consultation that still happens with Treasury, but most of the targeting now is towards the crossbench senators. We will see any change only really occurring once we get it to the Senate and there can be some debate around the way in which these rules will work. So now what I'm going to do is just walk you through how a lot of these rules work to understand how this might impact your clients, the calculations that need to do as you go through applying these rules. And there's going to be some new terminology that you'll need to understand as part of this process as well. So you can see here, a person will have taxable superannuation earnings for an income year if their total superannuation balance is greater than the large superannuation balance threshold, or $3 million. Okay, so from that point of view, where we have both a large superannuation balance that is above that threshold, and we have superannuation earnings for that individual that is greater than zero, and that can include both unrealised, realised gains and so forth, then we have a situation where the individual is going to be subject to Division 296 tax. And from there, we need to go through and work out, well, what proportion of that is therefore relevant for the application of that Division 296 tax. And once we work out what that proportion is, we then have to apply that proportion to the earnings that have been calculated, multiplied by that 15%. Okay, and I'll give you some examples as we go through as well. And the little thing at the bottom is that we do have to apply some rounding to that calculation to the nearest two decimal places, in essence. So one of the big things that this legislation is linked to, and we are also going to see a change in, is the notion of an individual's total superannuation balance. Because what you can see here, and what you would already understand, is total superannuation balance plays a role across a whole number of things that sit within the superannuation laws at the moment. The ability to make non-concessional contributions, the ability to use catch-up unused carry-forward amounts, the ability to apply disregarded small fund assets for self-managed super funds. The concept is already well used and well known, but it is going to make and have some adjustments made to it because of the fact that we are going to need to include things like defined benefits into the calculation, and there will be amendments to the regulations to enable calculation to be done for defined benefit income streams for Division 296. Okay, so from that point of view, we are not only looking at a new concept around what is defined as TSB value, but we are going to have to also look at an adjusted total superannuation balance calculation as well to determine the amount of superannuation earnings. So you can already start to see the different pieces to the jigsaw that we're going to have to work through. So the total superannuation balance as we know it right now, and you can see on the left-hand side there, is a concept of our accumulation phase value, our retirement phase value, and that retirement phase value at the moment is linked to our transfer balance account. Okay, so we look at our debits, we look at our credits, and in an accounts-based pension, so if you've got market-linked pensions, account-based pensions, in self-managed super fund land, predominantly, we are then needing to adjust back to the market value to determine what is the retirement phase value at that point in time. We then adjust for things like in-transit rollovers, certain post-1 July 2018 LRBA amounts, these relevant to SMSFs, and finally, we remove our structured settlement contributions. So items that are part of a personal injury payment that is received outside of super, and that money goes in. From the 30th of June 2025, this is all going to change because we now need to look at not the way in which the transfer balance account impacts retirement phase, but we need to, in essence, have all superannuation interests that are applied to an individual's transfer balance account adjusted to their market value. Now, we don't know how that is going to occur yet because within defined benefits, we will only find out that information once we have the regulations. And at this point in time, we have no regulations in respect to these rules. We only have draft legislation. But you can see there, it starts to bring in the combined values at the top here that deal with the same concept around what is the cessation value of that individual's superannuation interest at that point in time. So if I was to leave the fund right now, after my costs, what would my value ultimately look like? Okay, and that's an important concept to start to understand, because there are ways in which we can influence what the cessation value of an interest looks like, because it doesn't have to simply be the account balance. And I'll explain that a little bit further as well. The only other change that we're seeing here is the fact that we are excluding, for Division 296 purposes only, the add back that is required for post 1 July 2018 limited recourse borrowing arrangements. Okay, so for the purposes of making contributions for different things, if there is a LRBA that either has members in the fund or a member in the fund that has met a condition of release, or a related party loan, in those circumstances, and it's post 1 July 18, we need to add those items back for things like contributions. But for Division 296, we need to exclude that as part of that process. Fun and games, right? So then we go and we look at our earnings calculation. And this is really important in the context that we need to understand what is relevant, what is the proportion that is relevant to the member's interest that is above 3 million for the purposes of this Division 296 calculation. So the way in which I've drawn this is that if we have at the start of the year a situation where the member's account balance, or TSB, was say $2.8 million in the fund, then what we actually have to do is we create a floor at $3 million for the purposes of the calculation, because we're only looking at those amounts that represent balances above 3 million. So if we go from 2.8 to 3.4, start of the end of the year, we're not looking at the uplift from 2.8, rather we are looking at the uplift from $3 million. Okay, so it's only applying to that element that is above $3 million. So it's the greater of the prior year TSB or $3 million. And equally that occurs on the other side of the spectrum. So we have a ceiling and a floor here to ensure that we are only subject to the tax to the relevant proportion that relates to amounts above $3 million. And then, as you can see on the right-hand side, we are not looking solely at the total superannuation balance as I've just explained to you, but rather we need to make some adjustments to that for the purposes of determining the calculation. And that's why we then have in here what is known as an adjusted current total superannuation balance, because we need to reflect adjustments of events that have occurred throughout that year. Benefits that have been paid out of the fund, pensions and so forth, and contributions and so forth that have come into the fund. So we're trying to isolate this to earnings that are occurring rather than other items that influence the balance of the member as well. And this is where we end up with a fairly convoluted calculation of what adjusted total superannuation balance looks like. Because as you can see there, the calculation of total superannuation earnings in a year is not simply your balance at the end of the year less your balance at the start of the year, because we need to adjust for withdrawals and contributions that would otherwise influence that balance in that particular year. So we have a list of items, both in contribution and withdrawal, that we need to add back or subtract off. So here you can see in the withdrawals, these are all items that we would need to adjust for the purposes of determining the superannuation earnings calculation. So pension payments, lump sum withdrawals, these are items that we need to add back for that calculation. Amounts that are split in a family law context or a contribution splitting, and you'll see both of those, both in the context of withdrawals and contributions, because it depends if someone's paying or receiving amounts from it. There are also things like valid release authorities, but equally, as you can see on the right-hand side, there are items that would not get included in that withdrawal process. So we may see rollovers of superannuation benefits, we might get temporary income stream payments, so those sort of things we don't adjust, and a whole range of others there as well, from dishonesty and fraud, etc., etc. So these items, once we have our adjusted superannuation balance, we need to add these items back. Then what we do is we say, well, then we equally need to adjust off our contributions. And from a contributions point of view, what we're now doing here is we are adjusting for net contributions. So we are looking at 85% of the concessional contribution cap for that particular year. Okay, we are also looking at other contributions that may have been received in the year, like downsizer contributions. There is also CGT cap amounts. They didn't specifically look at non-concessional. You're kind of saying, well, you can't if you've got a situation where a person has more than 3 million. Well, technically you can. If someone made a downsizer and they actually didn't qualify for that to be a downsizer, what is that amount? It's a non-concessional contribution. What's their cap? Their cap is 0, so therefore it becomes an excessive amount. So they didn't actually capture some of that. So this is some of the drafting problems that are being looked at and assessed. But again, you can see here there are a range of items that are, again, needing to be adjusted for here. The death of a individual is a crucial one here that is going to substantially shift what the government says is 0.5% of our community, and 80,000 individuals are going to be impacted by this strategy, or impacted by this tax, I should say, not this strategy. And I'm going to show you when we think about death benefits later, how many more people are going to get caught up in this scenario. And you can see, again, we've got our contribution splitting, our family splitting. The difference insofar that, yes, we are adjusting for things like death insurance proceeds and TPD. Yes, year 1 adjusted, but that is it. Very different to structured settlement contributions, which have a permanent exclusion by virtue of their inclusion or exclusion from the total superannuation balance calculation. So there is some distinct differences in the way in which insurance is going to be held, and therefore the application of Division 296 of those monies being held inside super versus outside super. And again, you can see a number of items there that have been excluded from the way in which contributions will apply. So those amounts that would not be deducted. So let's give you an example now to try and help dissect a little bit more what I've just gone through from the mechanics. So we've got Jan here. She's a member of her self-managed fund, and she has, when this law starts, of course, 1 July 2025, these laws are intended to commence. The government, my understanding, is looking to introduce this bill in the first week of December. So these are going to be introduced well in advance, like we've seen the former government introduce all these different stages of tax cuts. So it will require, if it's legislated, any change of government to have to repeal this legislation. So that is an important thing to note. So we have a TSB at 30 June of $4 million. And then during the year, there are a number of things that have occurred for Jan. So we've got our concessional contributions, we've got a downsizer contribution, and we've got $150,000 worth of benefit payments that have applied as well. Okay? We get to the end of the year, and Jan's balance has grown to $4.5 million. Okay, so naturally, when we look at this and we want to try and understand how Division 296 might actually apply here, we aren't simply looking at $4.5 million and $4 million. We need to go through and look at the adjusted balance of Jan's total superannuation balance at 30 June 2026. And what you can see on the right-hand side there is that addition and subtraction of those amounts. So we need to say, well, we need to add back the pension withdrawals that she took during the year. But we also need to adjust off the net contributions, so 85% of her concessional contributions, and we also had downsizer contributions as well. So from that point of view, we can see that that balance has actually reduced to around 4.326 million. So therefore, we are looking at the adjusted balance at the end of the year, then minus the 4 million at the start of the year. So a basic superannuation balance calculation is not 500,000, but is rather 326,000. What is naturally important to recognise in here is that this is looking at both realised and unrealised income. So income and changes to market value and those assets that have been sold as well. Okay, so there is naturally some pretty significant concerns around funding of liabilities if you don't have the liquidity in the fund to be able to do that. So we move on, and what I said at the very beginning is that we need to look at two key items to determine whether Division 296 applies. So they are, does Jan have a total superannuation balance that is greater than the large superannuation balance threshold, $3 million, at the end of the financial year? Yes, she does. And two, did she have basic superannuation earnings during that financial year that are greater than nil? She had 326,000, whatever that number was. So on the basis that those two elements have been met, we will then have a Division 296 liability for her for that 25-26 year, okay? So how much is that? Well, the next step is that we need to go through and determine the proportion that represents her balance above $3 million. So in this instance, we can see, and we're going back to now our normal total superannuation balance, not the adjusted TSB. So the adjusted TSB was only for the earnings calculation. Now we're looking at the proportion, which is basically 4.5 million as a representation of the item above 3 mil. So a third of the benefit here is now greater than the $3 million, and therefore 1/3 of the super earnings that we calculated on the previous slide is the amount that we need to apply the 15% tax rate on. So $108,000 here are our taxable superannuation earnings for Division 296, which therefore means we have a $16,330 Division 296 liability. Okay? So these rules will apply in almost identical terms from here on in to the way in which Division 293 works. Okay, so our surcharge for high income earners. But we have a liability that then we say, as we are thinking about with our clients that might be impacted now, how do we actually balance this up with alternatives? So a lot of the discussion is do we keep this money inside super, or do we actually move this out and put it in other vehicles, structures, hold it individually, whatever the case may be? And the short answer is there is no hard and fast rule. Every client's circumstance is obviously going to be quite different, which provides some fantastic opportunities for you to go through and think about the quantum of money involved. And I think the bottom comment that I make down here, there are a number of factors that are going to influence the outcome, right? Do they have structures in place already? Do they need to have structures based upon their balances? What are the transaction costs going to be if we are going to make some shifts in respect to the assets that are held in the fund? Where are they going to hold those assets in the future, and what's your investment strategy going to look like in respect to those assets? All of these things will require you to provide some advice around the pros and cons of making these changes. Because simply saying, let's move this money out of superannuation and put it in Jan's name, if Jan's simply holding this money on deposit and then we're actually throwing this money out into her own name, and we obviously have a rate of interest and stuff that gets accrued on that, the tax that she might be paying outside of super might actually end up being worse than what the Division 296 liability is in there as well. Then you go, well, Aaron, yeah, but what happens if it's not all income and it's growth? You've got a combination of income and growth. Well, then the reality is you need to forward project of what growth might look like. I'm sure most of you have got crystal balls in your pockets or in your offices that kind of do a lot of this stuff. But this is what some of the challenges are going to present for you in dealing with clients about what steps you might actually take. The other thing that I would just like to highlight for you is that from a cash flow point of view for Jan, she might not like paying this tax, but if she's fairly heavily invested in assets to produce franked income, she might actually have enough franking credits that come back that really means she's not touching the asset base. She's going to get her tax refund first before she gets her Division 296 liability. Now, she might be relying upon that for other purposes, for cash flow and so forth. But again, these are all parts to the broader jigsaw that you're going to have to work through your clients with and think about. Are we going to be better if we're moving assets in your own name, in a trust, in a company? Can it be split? How can it be split? Etc., etc. So then, once we've determined here that we actually have a liability, then it's understanding the rules about how that liability will be paid. And as I said, this will look very similar to the way in which the Division 293 rules actually apply here. Because this is a Division 296 tax that applies to the individual. So the notion that this is a 30% tax that applies to super funds is not right. We have income tax that applies to the fund, and then the individual is subject to 15% on the movement of their value of their superannuation interest because they have a balance in excess of 3 million. Okay, so very distinct and different tax outcomes. In the fund, we can reduce the value of that liability based upon tax exemption, based upon franking credits. So we're not paying 30. In the large majority of these clients in the SMSF sector, we know they're 75 and older. So yes, they are going to pay a Division 296 tax at 15, but in the funds, they're probably not paying anywhere near 15% tax. And this is, again, weighing up some of these requirements. But yes, we can, if we want to, we can release this amount from the super fund. And I'll come to that shortly. But it is an individual liability. Now, there are some exemptions around the Div 296 rules actually applying. So they won't apply to where someone is entitled to a child pension from a superannuation death benefit of a parent. Okay, the expectation is those pensions will only run through to age 25. Yes, there are some exceptions in the Disability Act that would allow for that to go beyond that, but they are excluded. As I said before, the difference between personal injury payments that are received outside of super have a very different outcome to payments that are ultimately received inside of superannuation, because you can see there they are permanently excluded from that arrangement. And the other thing is that individuals who have died before the last day of the financial year will not be subject to the tax. So in essence, the year in which the individual passes away, no Division 296 tax applies unless you die on the 30th of June. So that is my one recommendation that you can apply to your clients in your advice. Please do not die on the 30th of June because you will be subject to Division 296 tax. These are the sort of things that were naturally raised, and Treasury go, oh yeah, but they were alive for the whole year. So therefore they should be subject to Division 296 tax. Yeah. So we have longer periods to deal with these things than we would ordinarily have for other elements inside the income tax and superannuation laws. The government has recognised that liquidity to pay these liabilities is going to be more problematic than other aspects of superannuation law, like Division 293 in the Tax Act. So there is an 84-day time frame to get that payment done from the time in which that notice of assessment is issued by the ATO. Now there's also some further extensions around amendments. The other interesting thing is that the general interest charge, they have also recognised that they won't apply the general interest charge that sits in the Tax Administration Act, which is currently sort of north of 10%. They're matching the rate here to look more like what a loan would come from the bank. Okay, so how generous of them. So 3% above the base rate. So there is about a 4% differential on interest costs there. And again, recognising some of the challenges around the fact that there are going to be liquidity issues of being able to fund this liability. So again, we get to choose. We get the liability. Are we going to have that individual pay it personally? Or are we then going to send a release authority to the super fund to request for that liability to be deducted out of the individual's account balance? One thing is there is absolute flexibility around what interest they want to take that from. If they've got APRA fund and self-managed funds, you can choose which fund. If they've got multiple interests in the fund, you might have a client that's got 2, 3, 4, 5 pensions and an accumulation account. You can decide where you want to access those benefits from to be able to pay that liability. So by account and by interest within the fund. And this is where a lot of the problems that have been flagged from within the industry come about. Because we have naturally a significant quantum of things like farmland because of the business real property definition that sit inside self-managed funds. So we know if the predominant asset is farmland, there's going to be no ability for the liability to be funded from inside the self-managed fund. So they're going to have to pay for that somewhere. Now we know that drought, flood will have very different implications year on year on year. So therefore, we can't carve off a piece of land and handball it off to the tax office either to pay the liability. So these are some of the real and live issues that have been pushed back around, well, how are these individuals who have played by the rules now going to fund these particular arrangements? And the other one is around things like startups. So there's a couple of good examples. I think talking to someone the other day, they said, oh, Afterpay. Someone invested in Afterpay, right? There. You could look at biotech stocks. You get an example where someone goes, yep, we're looking at a cancer drug. First trial's been fantastic. Share price went from there to there. Push someone from $1 million to $4 million. Phase 2 of the trials, account balance, they've still got to pay the Division 296 liability. They're never, ever really going to get to $3 million ever again because those trials are done and dusted. Now, the government might argue, well, they get a benefit because they didn't use it in that year, well, they can apply it in the future. They're never going to use it. This is the impact of what unrealised gains is going to have because of the drafting of this, the way this legislation is drafted. The government has been hell-bent on being consistent in its application for all superannuants, APRA funds, self-managed funds, defined benefit interests, accumulation interests. So they're trying to put square peg into a round hole for everyone. And these are some of the problems that are starting to exist by having one set of rules that deal with this overall thing. So let's move on and talk through this other little bit. So we get to the next year, we can see some contributions, we can actually see some withdrawals, and we therefore, at the end of the year, see the TSB have declined. So in that instance, again, we need to go back and look at our adjusted total superannuation balance, because it's not simply just looking at the decline in value, it's saying, well, we had $200,000 of pension withdrawals, we're going to add that back and adjust off our net contributions. So yes, we have a loss, but it's nowhere near the loss that if we were just looking straight at TSB. So we therefore have now what we call transferable negative superannuation earnings. Another term to deal with. But ultimately what that says is on the basis that we look at that criteria, did we have a balance above 3 mil? Yes. Did we have balances of less than 0? Did we have balances above nil? No, we didn't. It's negative. So therefore Div 296 does not apply. And on that basis, those items can be carried forward to subsequent years to allow for it to be applied off gains in the future, or earnings, superannuation, taxable superannuation earnings in the future. Okay, so they don't lose them, they are just applied, they are not transferable. So if they die, though, any unapplied earnings die with them. So it doesn't carry across like a pension. Once you're done, you're done. So the other final thing that I want to talk about here is around a member's death. So, and the nuances between reversionary and non-reversionary pensions. Because what we have here is an example where the member dies on the 7th of April 2026. Both of these individuals are below their personal transfer balance cap. That's our bottom line. And then we have our $3 million threshold above that. So Div 296 is not a concern in any way, shape or form for these two individuals until one of them dies. And what you can see here is with a reversionary pension, when does the individual become entitled to that pension? Straight away, right? Now, there's a difference here between our transfer balance cap and our total superannuation balance. So when, for our transfer balance cap, do we need to look at that creditor plane? We get 12 months. So we can, in the middle here, we've got 12 months to ensure that member B here, who is, member A, I should say, member A has got 12 months to comply with their personal transfer balance cap. So they might roll some money back, their interest, and then have the pension credit to them, etc., etc. Okay? Total superannuation balance, they become automatically entitled. So from the 7th of April 2026, they now have a balance that is greater than $3 million once we get to 30 June. So what happens from a Division 296 tax point of view? Div 296 is not relevant for member A, right, on the death of that individual, even where their balance is above 3 mil. So where the person dies, that first year, or their last year, unless they died on 30 June, we ignore that. Then, for member B, for year one, which is that first year, first year, we adjust back the reversionary pension. So they don't have a Division 296 liability in that first year. But from then on in, they're now caught in that regime. And there would be a relevant proportion that I've gone through with you to determine what that would actually look like. Now, let's flip the switch here and say, well, what happens if this is non-reversionary? Because using the exact same rules, the member dies at that point in time, we know in the legislation we must cash that benefit as soon as practicable. What is as soon as practicable? It's ultimately at the discretion of the trustee to be able to work through the time that it would take to resolve and then decide what would need to occur. In this instance, because they died on the 7th of April, it is not unreasonable for that individual to start an income stream, if that's what they choose to do, post 1 July. Post 1 July. Therefore, total superannuation balance, when does that increase their total superannuation balance? It has an influence on the following year, not the immediate year when they would have been automatically entitled under a reversionary situation. So in this instance, the outcome here is that we have avoided Division 296 in that subsequent income year. Because in that subsequent income year, that is the first year in which they became entitled to a death benefit income stream. And it's from that point thereafter that then Division 296 would actually apply. So thinking about the construct of your income streams, not only from a transfer balance cap point of view, but also in this context, in certain situations, now, unless you all know when your client's going to die, obviously 1 August versus 1 April is going to potentially be a very different outcome. But if you're in the business of managing risk, which many of you are, it may be prudent to think about the differences between what reversionary and non-reversionary pensions actually look like here. So there are some practical issues, and I'm conscious that I'm over time now to take some questions around this, and there's probably a whole heap of them in there. So we are waiting on some regulations in respect to this area. We don't know yet what's happening from the point of view of defined benefits. All of that stuff's going to be caught in the regulations. The changes to TSB calculations may also impact a range of other areas, like disregarded small fund assets, NCCs, carry forwards, and so forth. That concept of tax effect accounting is also going to be relevant in respect to cessation value, and we suspect we're going to have to see some amendments to the SMSF annual return, for example, because of things like insurance proceeds, contribution splitting, like family law splits, all those sort of things that we don't necessarily have labels on the return for as well. So how fun's that? How's everyone's head? Did anyone drink a lot last night? Now their headaches just got worse?
Yep, a lot more complicated than we thought it was. Now, Brendan Lynch, I think your question was already answered throughout the slide, and so is Adam M as well. So let's start with David's question, which is, why was unrealised capital gains included?
Yeah, so why was unrealised capital gains included? If we kind of knew that, no, I'm just kidding. The reality is the government is trying to create a uniform way to apply this for APRA-regulated funds and self-managed funds. APRA-regulated, the level of detail that is included in the SMSF annual return simply isn't replicated in terms of what we see in an APRA-regulated environment. So therefore, the ability to have to change systems within APRA land, so someone like, I spoke to Craig Day at Colonial, he's kind of said, well, yeah, it might cost us $15 million to change our systems for a very small proportion of individuals that are going to be impacted by these rules. So of the 80,000, the large majority are self-managed super funds. The argument that has been put forward is, well, why can't we create a different set of rules? So because we know actual earnings, so it's not that we're against, as an SMSF industry, the fact that the government wants to look at revenue and determine, you know, a collection of Division 296, but let's look at carving out unrealised gains, because we could actually achieve that within an SMSF. So let's have method A based upon an actual result, and if you can't use method A, then you default back to this. The government just hasn't really been interested in listening, is the short answer.
Okay, very well. So next question, this seems overly complex for a relatively small tax revenue. Any thoughts on that?
Yeah, so I guess it becomes a byproduct of the concept of the total superannuation balance. So that is why we end up with something that is quite complex. So the fact that we need to go and adjust for withdrawals and contributions and so forth. There have been proposals put forward to government around alternate measures. One of those, I know the SMSF Association has put forward, was using some sort of deeming rate. Now, there were conditions attached to that deeming rate in respect to that applying. That could be a much cleaner approach. There are deeming rules that sit within multiple parts of legislation. So again, at this point, there doesn't really appear to be appetite for that. Again, as I set up at the very beginning, the reality is that there will be more, or there has been discussion that's been had with crossbench senators. So all of these items have been naturally flagged to them. Whether they're prepared to take all that on board as part of their own negotiations as they work through other aspects of bills. So it's all very political, as the name would naturally suggest. So yeah, so I think at this stage, we're just kind of waiting to see, which is why these are all hot topics right now, because they are literally live and burning in Canberra.
Right. And how will advisors be able to track carried forward losses?
This is the fun and games of advisors being able to access anything on their clients, isn't it? So this is going to rest with the individual, which is why, you know, this is an individual liability. So like all good things, they will probably sit on MyGov. They will therefore, they would then need to naturally provide that. Like with advisors, you're probably having to ask clients to be able to get access to that information. So you can pretty much just add it to the list.
Oh, well, that will take time though, putting up my go as well.
Yeah.
How do you determine unrealised CGD on property values?
How do you determine...
Unrealised CGD.
Yeah, okay. So this is going to be the doozy, because as you all would know, we need to go through an audit process with our self-managed super funds every year. And one of those key requirements is that we must ensure that assets are valued to their market value every year. So that sits within Regulation 8.02b. This is where it's going to potentially become quite problematic. And there'll be some argy-bargy with auditors around valuations. What have we got? How are we determining valuations for unlisted investments? Ultimately, how we satisfy what an auditor would require for them to meet their audit requirements under the compliance aspect of the audit. So the property ultimately will come back to the valuation guidelines that we have around determining value, and it's fair and reasonable, it's supported with evidence and so on and so forth. But there will be an argument to get sworn valuation, things that can kind of push it as low as it possibly can in a market valuation context. So, but it does come back to, in a total superannuation balance definition, looking at and including things like exit costs, because you literally can look at, in the context of TSB, the termination value. So what is the value of the interest inside this fund for the member that has commercial property, residential property, because there would be literally transaction costs attached to that. There would be unrealised gains that you might have on that asset at this point in time that you can use the tax effect accounting inside of that. For those of you who don't, just speak to the accountant if you need to find out a bit about that ultimately. But these are things that you can factor in to try and reduce from what is the account balance to what is their termination value if they were to leave the fund. And that is a distinct difference and something that we need to understand and spend a lot more time on, because it will determine what that difference is as not being subject to Division 296.
Lovely. I'll move on. So
Okay. All right, so if you've got a headache, I'll probably just ramp it up just a little bit more. So the other aspect here, and the reason why I asked the question earlier around how many people have a self-managed, so just show of hands again, how many people have a self-managed fund in this room? Keep your hand up if you use services within your business to assist with that self-managed fund. So this is at the very heart of what I'm talking about. Because what we have here, and this has been going on since 2016, the government initially had, or the ATO actually had a draft piece of legislation that was looking to change the rules around the non-arm's length income requirements. Okay? This is a problem that has been created that technically doesn't even exist anymore. And I'll talk to that a little bit later. But ultimately what we have here is a bill that is before Parliament, currently going through a Senate inquiry, and there have been submissions and a number of professional bodies that appeared before that Senate inquiry last week trying to get a satisfactory outcome with this. What we have, so I was just answering questions there about why can't we exclude unrealised gains, and the fact that the government wants one set of rules that should apply to all funds. Government here, same government says we need to create a different set of rules for self-managed super funds when we compare them to APRA-regulated funds. Right? These are the two single most important pieces of legislation impacting self-managed funds at the moment, and they run two different scenarios around the way in which they're trying to apply the law. Right? It's mind-boggling. But what we have here is non-commercial arrangements that we have expenditure that is incurred or even not incurred where there is a benefit that is attained by the fund. Now, this is not a superannuation law issue, this is a tax issue, because the arm's length requirements in super law says that if you have an arrangement that is more favourable to the fund, tick, good on your fund, moving on. But from a tax perspective, it says where you have a result that inflates the net income of the fund, so the net result, because you didn't incur expenditure, that will be taxed as non-arm's length income. What we need to do is we need to understand, does it relate specifically to an asset, or is it in respect to general expenses that are incurred in the fund that can connect that expense to all of the income of the fund? Okay, and this is where we are looking at requirements of the latter. Okay, and the government has been trying to work through this, and we've been consulting for many years to the extent that the ATO has had a safe harbour, a practical compliance guidance that in essence has granted relief right through till 2023, 30 June. So what we've got here is a very disproportionate outcome that if we don't charge a fee for a service that we are performing to our fund that can connect to all of the fund's income, the ATO's current view is that you taint all of that income and it is to be taxed at 45%. Unless you have a commercial arrangement in place. Okay, so the outcome currently is that we need to look at the service that has been provided and what has been charged or not charged, i.e. you're providing that for free, and what should have been charged because you ordinarily charge those services to the public at large. And whatever the difference is between those two items, we need to apply a multiple of 2, and then we will determine, once we adjust for assessable contributions and so forth, when we look at the lesser of those two amounts, we would then apply the non-arm's length income to that rate. Now I'll go through the nuances of the calculation of that top bit there shortly, but in essence we would apply a multiple of 2 to that difference and then apply the non-arm's length rate to that. The rest of the income of the fund would be taxed concessionally. So here's a couple of services, and you can interchange these in a number of ways. And actually, before I go through the example, I'm going to go down to here. What might get included in the context of general expenses? So things like accounting fees, actuarial costs, fees of an auditor, general legal expenses. So these are not just incurred within your business, they might be provided to family members, that sort of stuff. General investment advisor fees. So in that respect, we're looking at fees must relate generally to the operation of the fund and not specifically to assets. But if you're doing investment strategy work and you're using the software and the resources in your business to help manage the portfolio, that stuff gets caught in here. So let's go back to these examples just to show you some of the nuances of this. And again, you can interchange these, but we have an SMSF, John, sole member, he uses his accounting business, and his accounting business provides the compliance services. And what you've got to remember here is that what hat is he wearing? Is he wearing his trustee hat? Or is he actually wearing his individual capacity hat? And what I mean by his individual capacity hat is section 17B says if you are qualified to do so, you run a business providing those services to the public at large, you have the insurance and you can charge a fee as long as you're doing that commercially. Okay? So you don't have to outsource it to someone else. As we know, the definition of an SMSF says you cannot charge for trustee-related services. Okay, so you've got to understand what hat's he wearing here. So he's wearing his individual capacity hat because he might be using the software in the firm, he might be using staff to help him get that work done. These are all things that need to be weighed up. Now, when he does this work and he would bill a client, they would charge $3,000 for that work to be done. But he actually gets these done for free because it's his business. The problem is because he's doing this in his individual capacity and he's using the resources of the fund to be able to achieve this, what we end up with is a non-arm's length arrangement, and therefore we would actually have to uplift that $3,000 of benefit that he's getting by that factor of 2 and apply the non-arm's length income rate to that amount. Now, we need to go through a calculation of what income has the fund had for that particular year, and you can see there, once we look at the rental income and deductions and so forth, our taxable income comes out at $15,000. So we need to, if I go back here, we're looking at the NALI being the lesser of 2 times the general expense breach or the total taxable income less the assessable contributions. So in this instance, the 2 times breach is lower than the taxable income less the contributions. So therefore, the non-arm's length component is the item that we have to multiply by 2, and then the remaining income of the fund is concessionally taxed. So why 2? Good question. Previously, all of the fund's income was taxed at the top marginal rate by virtue of the way these rules were drafted. They went to 5. Consultation got it down to 2. And then obviously we're at a concessional rate. So I reckon they might have got a dart at a dartboard and just went, I guess, there is no rhyme or reason. This was not mentioned at any stage during consultation that has occurred for many, many years. So it feels like ultimately they just landed on something that wasn't as bad as how the rules are currently drafted, can't be anywhere near the concessional rate that currently applies, and has to be somewhere in between. They tried 5, got shot down pretty heavily, rolled it back to 2, don't like it, but we'll kind of cop it and move on. The other side of this then is if we look at legal services, and again, what I'm simply doing here is exploring the fact that we need to go through the calculation to determine whether non-arm's length income applies, or the component applies from the taxable income calculation, or simply as a function of the difference between what was charged and what should have been charged. So in this instance, we've got, yes, there was a fee charged at $12,000, but it should have been $17,000. So therefore, our non-arm's length component is 5,000 multiplied by 2 gives us 10. But once we actually start to work through the machinations of the tax return, we actually end up in a situation where the taxable income is less than the non-arm's length component. So therefore, we revert back to that rather than the 2 times figure. Pretty easy, isn't it? So again, just understanding those nuances that exist. So as I said, these are the sort of things that these rules are targeting, which is why I note for you that things like general investment advisor fees, so this is not specifically to an investment that you might be placing that may have been done on some sort of non-commercial term. Because where it is done specifically, these rules have applied since July 2018. Okay, so where there is a cost that is incurred, and the best example I can give you is you've got a real estate agent. They provide tenancy services to the public generally. They provide a discount to their own fund in respect to the rental management of a property that's acquired in the fund. That discount is an issue because it relates specifically to that asset. And that has been a gnarly issue since 1 July 2018 and has no application to everything that I'm talking about here, because we're looking at general expenses that can connect to the entirety of the fund, not to specific expenses that can relate specifically to particular assets. So as I said, we have different requirements. Our safe harbour that we've relied upon through to 30 June 2023, the ATO has previously indicated they do not intend on obviously continuing that because of the fact that we were going to get some resolution to this as we have continued to work on. Interestingly, there have been a whole host of private rulings that have gone into the ATO, and quite clearly, subject to what hat you're wearing, you're getting very different outcomes that come out the back of this as well. So are you a trustee doing the work and you're doing this at home on your computer? Yeah, you might use the software, but you're actually doing it outside of what your working environment would be, and you're not using the team to do it, but you're wearing your trustee hat. Just because you've got the skills to do it doesn't mean that you can't wear your trustee hat to undertake some of those activities, okay? But as soon as you cross over to that individual capacity hat and you're relying upon Section 17B, well then it's a very different story, okay? So again, understanding those couple of nuances there as well. Once these laws get finalised, then we will arguably then see a further update to that Law Companion Ruling 2021/2. But we do have a number of problems that remain unresolved at the moment. And the best one that I can kind of walk you through here is a specific one around things like builder clients, because there are a number of examples in the ruling, and the most kind of reference one that we see is around an example of Trang, and she's a builder, and she goes in and she does some improvements and stuff in respect to the property that is inside the fund, and ultimately is tainting that asset both from an income perspective and a future capital gains perspective for non-arm's length income purposes. So these are the sorts of things that we're trying to get resolved as part of this approach. So you can see there some of the issues that we're trying to look at and where we identify. So things like asset repairs, investment advice, expenses relating to building and acquiring and units of a unit trust and so on and so forth. So the bit that I wanted to touch on is where we have some unresolved situations. So in this instance, if we look at the example here of Sam, so Sam's a director member of his SMSF, he is a qualified electrician, and he goes in and he does things that he could ordinarily do in respect to that property because he is qualified to do so. But the problem is he cannot wear his trustee hat to do this work because not anyone can just go and start doing wiring in their own home, right, or in an investment property. You have to be a qualified electrician to be able to do so. But when it comes to Section 17B and the requirements around that, you in essence need to be the business owner. You can't be the employee in respect to undertaking that work. So the problem then becomes someone like Sam is caught in no man's land here because he can't rely on either of these two rules. Now, what we are seeing at the moment is there is an update to the tax ruling about what is a contribution, and it would appear that this sort of thing would get caught up or would fix this issue whereby the difference between what is provided would be a contribution. Okay? And that's where really the fix of this resides, because what we would like to have it do is recognise that this problem actually doesn't exist in theory. Where did all this start? This all started back when the government of the day in essence was going to allow for zero interest related party limited recourse borrowing arrangements. Okay, and then what we saw was the ATO changed their view very quickly. They said, well, that is fine for superannuation law purposes, but it's not fine from a non-arm's length income perspective, and therefore we are going to tax that sort of arrangement at 45% unless you comply with a safe harbour provision. We saw the introduction of that safe harbour within PCG 2016-5, and a lot of that mischief ultimately was tidied up. These rules were designed to impact that sort of thing, and then it has literally grown a life of its own. So the view is that this is all been fixed. Why do we need this? This creates more problems than it's trying to fix. And that is really where it is currently situated. The view is that it would be better repealing this legislation and actually taking us back to prior to 1 July 2018. Okay? The fact that we're starting to introduce into tax law differences between how rules will apply for APRA-regulated funds and self-managed super funds is not good policy. Now, if you're as boring as me and you sat there and watched a Senate inquiry last week, I like riveting stuff if you ever get the opportunity to do it. But the discussion is literally saying, well, if it's an integrity measure that you're trying to achieve around self-managed super funds to be compliant with these laws, don't sit it inside the Tax Act, make a change in respect to the superannuation laws and around arm's length dealings. So let's put something into section 109 that says, well, you've got to enter into arm's length arrangements, full stop. Not that it advantages the fund, but that it is done and represents commercial terms. Then it gets caught under the compliance requirements for the auditor. And then we have mechanisms that if there is an increase in the value of the fund, it will get included into contribution rules and contribution caps. And therefore, we also have integrity measures that deal with excess contributions as well. So the view here is that we would like to get to that point. There appears to be, and I sort of say this with a half glass full approach rather than a half glass empty approach, but the senators in that inquiry seemed receptive to that approach. So not to the importance of having an integrity measure, but making sure it was fit for purpose. And the problem at the moment is we don't have legislation here that is fit for purpose. And ultimately, something that happened previously, we're now trying to fit, again, a round peg into a square hole here. So, spot fires or wildfires, I thought I'd finish off with, because that is the reality at the moment with those two measures. We have a government that really doesn't appear interested on the Division 296 stuff to further consult. I think the lip service around a 2-week consultation really showed where they're heading with this. There has been countless times and opportunities to consult, providing feedback on things, and most of that unfortunately has fallen on deaf ears. So therefore, the avenue forward is to naturally look at things like crossbench senators, as I said before, and the reality is we're going to go down an exact same path as we currently are when it comes to the non-arm's length expenditure rules. That's where I envisage it's going to land. We will then see some regulations come out. Hopefully, when this goes to the Senate, the senators say, how do we know how this is going to work? We haven't even seen regulations yet. And therefore, we start to see more and more discussion about it. But this government appears like they want to sort of push this through. And as I said, the expectation is it will go into Parliament in the first week of December at this point in time. That's the mail that we've had. So that is it. Thank you, everyone. Happy to probably take a few more questions that we've got now and wrap up the session.
Yeah, we've got a couple of minutes for Q&A. In relation to Harley's, talk about that.
Yep.
Am I on? Yep. Okay, do hairdressers and lawnmowers get penalised for doing their own hair and lawns?
They're not.
Okay.
Well, the hairdressers probably not, because I don't know that that's related. The lawnmower, if he actually goes in and mows his own lawns, then that is a slightly different issue. Yeah. So the hairdresser, I don't know how their hair would relate to, cutting their hair would relate to the self-managed fund, but that's.
Well, I'll talk to this question.
Yeah.
Very similar to that one. Can you explain the gnarly rules regarding an SMSF member carrying out manual work on property owned by the SMSF? So the issue there, and this is the Trang example that we're referring to, is that where they are getting involved in an activity that relates to the fund. So the fact
You're not wearing your trustee hat. You're wearing your hat that relates to you being in your individual capacity where you would ordinarily be allowed to charge your fund for that service. Because you hold the necessary skills, qualifications, and run a business in that respect, the current law would in essence taint that arrangement in an income and a capital perspective. Okay, so income and capital gains on the disposal.
We have a question over there.
Yep. Yep. So we've got an individual yep. Yep. Well, again, the only way, so it's probably more like the electrician example with the employee bit. The problem there is well, he's not wearing his trustee hat to do that. Unless some of those things are incidental and insignificant in their functional value. So fixing washers on a tap, fixing what is a trifling or insignificant thing, as opposed to something that then might naturally increase the value of the asset generally, then you have a bigger issue. But then again, what hat are they wearing, and potentially the problem that exists, like I said with that electrician example. Yep.
Okay, well, let's make this last one. We're almost out of time. It almost seems like the tax cost can be greater than the assumed cost for the service.
Well, in essence, that's the whole argument that's been trying to put forward. We're trying to fix a problem that no longer really exists, and therefore let's go back to where we were, and if we do need any other integrity measure, well, we feel that there is a better way to try and achieve that.
Thank you. Thank you so much, Aaron. That was
That's all right.
really great. So much info. My head's exploded.